And joining us now in the studio for his perspective on the market turmoil is Economist correspondent Stephen Long. Stephen, what's driven all of this?
A confluence of factors, really, Steve. Clearly, the big picture is fears of recession, fears that the advanced economies are headed for a fully fledged recession, that you will see governments or sovereigns default on their debt, possibly banking collapses. But there are also technical factors, and the intervention by the US Federal Reserve a couple of days ago, so-called Operation Twist, to some extent has backfired. It surprised the markets, surprised investors. It wasn't what they wanted. And it's the way it's been done in a technical sense has meant that a lot of people had to unwind bets on what would happen with stocks, with bonds, with currencies, with commodities, and that's added to the problem.
Let's talk a bit more about Operation Twist. I think some of the headlines are saying Operation Twist not worth shouting about. What's been the failure of Operation Twist?
In theory, you can see what the Federal Reserve is trying to do. What they've done is they're selling a whole lot of short-dated US government bonds, 400 billion's worth, and buying 400 billion of long-term government bonds. And the reason they're doing that is it's those long-term bonds in America that really set the interest rates for home borrowers, for corporate borrowers, in theory, and it has pushed down those rates indeed to record lows for those long-dated bond rates. But people are saying, well, how can it work? We've had all this easing, interest rates are already at zero, there just isn't the demand in the economy, you're pushing on a string, it won't work. And it's like running up a debt on your Amex to pay off your Visa with this swap of short and long bonds. So the markets just aren't buying it, plus it's made some trading more difficult and added to the volatility.
So where's the world economy at compared to September 3 years ago when Lehman Brothers collapsed?
It's still not as bad. Back when we had that big credit crunch after the collapse of Lehman Brothers, we were on the brink of a complete meltdown of the global financial system, and the flow of lending absolutely dried up, and we headed into a very deep recession, the Great Recession it was called. We could have headed for a depression. It didn't go that far, but it's maybe a question of yet. There are extraordinary things happening. We've had those US bond rates fall to record lows. We've had the downgrade of the Italian government's debt. Now we've seen Italian banks downgraded. The Italians alone owe 120 billion euro. They have to roll over 120 billion euros worth of debt. Never mind Greece, a huge economy like Italy. People fear an insidious nexus between the banks and the governments leading to a downward spiral. We don't really know where this will end. And
not even gold is a safe haven at the moment.
No, we've seen the gold price fall as people have had to liquidate their gold stocks to meet positions that are coming undone on other investments. And so the question is, where's the safe haven? Normally you can invest in one thing, and if it goes bad you invest in something else. In these circumstances with the wild beast, as Kevin Rudd put it, in such a terrible state, there just doesn't seem to be a safe haven. And that has enormous implications for the financial system.
So is Australia a safe haven? Are we inoculated from all of this?
We're in a better position because Asia is still growing in the emerging markets. But, Steve, we have seen signs of cracks in China. We've seen for the third month in a row manufacturing output fall in China. Now commodity prices are falling. Australia is not immune if this gets bad enough, although clearly I'd rather be here than Greece, Italy, or just about anywhere in Europe or the US.
Stephen Long, thanks for coming in.
You're welcome.